The next indicator we're going to study is the ATR, also known as average true range. It is primarily used to measure the volatility in the market, so how many pips on average that currency pair moves in a certain period of time. And while it's not very useful to understand the direction of the market or to set entry points, it can be a huge help in setting exit points, so stop loss and take profit. The calculation for it is very simple. First, let's see what is the range that the ATR calculates. The range is simply the high on the candlestick minus the low. So the ATR calculates how much the pair has moved during the candlestick's period by simply measuring the distance between the highest and lowest price in that period. For example, this candlestick has an open price of 1.052, a low at 1.051, a high at 1.057, and a close at 1.0545. Pause the video and think about the range of this candlestick. The range is calculated from the high to the low in order to cover all the movements in the candlestick, so the range here is 60 pips. So we understand how the ATR calculates the range, or we should say the true range as it is called in this indicator. We still need to understand the first term of the name, the average. Why is it average true range? Average of what? The ATR value is not calculated on just one candlestick, but on a number of candlesticks that we define. This number of candlesticks to define is called period, just like we have seen in other indicators, such as the moving average. So let's say that we choose a period of 5. The ATR will measure the range of each individual candlestick and then apply the average, which means that it sums all the values of ranges and then divide by the period, which is 5 in this example. Let's put it on the chart and see what else we can discover about this very useful indicator. So we go to indicators, type ATR, and here we have it. It will appear at the bottom of the chart just like the RSI or the MACD. Let's have a look at the settings first. In inputs, we have length, which represents the period of the ATR. The standard period is 14, which means that the ATR calculates the average of the ranges in the last 14 candlesticks. Now, I've been studying and testing indicators for years, and I can tell you that the period of the ATR is crucial, as it determines the sensitivity of the indicator to market movements. While the moving average, for example, if you increase the period or decrease it by a small amount, it won't have a huge effect on it. For the ATR, it can make a huge difference. 14 is a balanced period, and I suggest to keep it like this. If you start to go lower than 14, let's say around 10, the ATR will be very sensitive to price movements, and it can be hard to interpret. If we go above 14, let's say around 20, then the ATR will have a reduced sensitivity, so it will react more slowly. I'm not saying that 14 is the best period to use for everyone, no matter what, but it's definitely the easiest one that can fit pretty much all the trading styles. I also have a more advanced course about indicators in which we discuss more in detail the nuances of different periods for the ATR with backtests and results on different periods, but remember that here we are trying to build a solid foundation for you to transition from a complete beginner to an intermediate trader and come up with your first profitable trading strategy. This is more than enough for now. Then, if in the future you want to explore the world of indicators more in detail, in particular for the ATR, you can take the advanced course. For now, there's no need to deviate from this. We can certainly build a profitable trading strategy by sticking with the standard 14-period ATR. Then, going on with the settings, we have smoothing, which simply means what kind of average we apply when calculating the value of the ATR. We have 4 options: RMA, which stands for Relative Moving Average, SMA, which stands for Simple Moving Average, EMA, which stands for Exponential Moving Average, and finally WMA, which stands for Weighted Moving Average. If we want to calculate a simple average of the ranges, then we can use the SMA. The standard option on TradingView is the RMA, which is a type of moving average that has been introduced for the first time by J. Wallace Wilder. Yes, it is the same guy of the RSI. The difference between the relative moving average and the simple one is that the relative moving average gives more importance to recent price movements. So if we choose the RMA, the most recent candlesticks range will have a bigger impact on the calculation of the ATR compared to the least recent candlesticks range. Once again, I think we don't have to go for complicated things in this course. That is why I prefer a simple moving average. So I select SMA. Time frame, we leave it as chart, then we switch to the style tab, and maybe I want to change the color to have a better view of the line on my chart, and also want to make it a bit thicker. And alright, now we have a nice blue line for the ATR, which is very clear. At each point on the chart, we can check the value of the ATR on the top left of the indicator's interface. So at this point here, we have an ATR value of 0.00051, so 5.1 pips, which means that the ATR calculated the range of 14 candlesticks, starting from this one going backwards, then applied the average, and the result is 5.1 pips. What does this result mean? It means that the average volatility in a period of 5 minutes, since we are on a 5-minute time frame, is 5.1 pips, so we expect the next candlesticks to move around 5.1 pips. So with the ATR, we have an idea of how much a candlestick can move. We have already started volatility in this course. In particular, we have started volatility related to different trading sessions. We said that the London session has good volatility, then it tends to increase with the overlap with the New York session. Then the London session closes and volatility tends to decrease. At the end, with the New York session about to close, volatility tends to be very low, and this goes on for the Tokyo and Sydney session, until once again the London market reopens. Let's see if the ATR reflects this situation. We start at around 6 AM UK time. Volatility seems to be quite low, with the ATR that is at 2.4 pips. Moving on, with the London session starting, we see that the volatility is increasing, with the line of the ATR going up and showing levels at around 5 to 6 pips. With the overlap between the London and the New York session, the volatility reaches a peak, with the ATR showing values above 7 pips, sometimes even above 8 pips. Then the London session closes and the volatility decreases, and we see it decreasing till the end of the New York session. During the Tokyo and Sydney sessions, we have low volatility with the ATR between 2 and 4 pips. So the ATR seems to represent very well the volatility of the market. You know, I once noticed that it's also a pretty accurate reflection of my caffeine levels throughout my trading day. An increment of coffee starting from the morning till afternoon and going down at nighttime. And I'm sure that if there is any full-time trader following this course, I'm sure that you can relate to this. Well, jokes aside, how can we take advantage of it to set stop loss and take profit? The first thing we have to do is to understand the direction of the market and the market structure. I'm not going to conduct a thorough analysis here because I want to focus on the exit points using the ATR. So let's say that here we have a downtrend highlighted by a possible down channel, maybe like this. Okay, looks good enough to me. Then we need to enter our position. We are in a bearish market, we want to look for short positions. I skipped the usual process with the RSI because once again I want to focus on the ATR. So let's say that I enter here where we have a good candlestick rejecting the upper part of the down channel. Now, what about the stop loss? Generally, we place our stop loss outside the market structure, and this is totally correct. But sometimes, especially beginners, may start to have doubts, such as, okay, outside the market structure, but where exactly? Is 2 pips above the key level enough? Or maybe 10 pips? Is there a way to know exactly where? This is when the ATR comes to our rescue, and I want to show you 3 different methods of placing the stop loss with the ATR. The first one, which is also the most used way, is to place a stop loss that is twice the value of the ATR. So if we hover the mouse cursor over this candlestick where we have our entry, we can read that the value of the ATR is 7.6 pips. Let's open the calculator and we are going to do 7.6 times 2, which gives us 15.2. So with this method, we're going to place the stop loss 15.2 pips far from our entry, and we can amend this in the settings for our trade. So this will be our stop loss well outside of the market structure. A second method is to place a stop loss that is 1.5 times the value of the ATR. Once again, we have an ATR of 7.6 pips. We use the calculator to check 7.6 times 1.5, and we have 11.4 pips. We adjust the stop loss in our position, and here we have it, once again outside the market structure. Now, in this particular case, it happened that both methods placed the stop loss outside the market structure, but it's not always the case. Sometimes we may have values of the ATR that are particularly small, and we place the stop loss inside the market structure. Some other times we have values of the ATR quite big, and we place our stop loss outside the market structure, but too far away from the key level. That is why I want to show you a third method, the one I prefer. In this case, we first place the stop loss right on the key level, so something like this. Then from here, we add the value of the ATR to our stop loss. In this case, we add 7.6. Let's use the calculator once again, just to make sure that we are right. And okay, let's amend this position. And here we have our final stop loss. I believe that this way of setting the stop loss with the ATR makes a lot of sense. Many times we see in trading that we are right about the direction of the market, we are right about the entry, but then a sudden spike goes temporarily against our trade, hits the stop loss before going in favor of our trading idea. Placing the stop loss at a distance of 1 ATR from the key level can definitely help you avoid a situation like that. In addition, with this method, we always make sure that the stop loss is outside the market structure. What about the take profit? We can use a multiple of the ATR to set the take profit, just like we have seen for the stop loss. For the stop loss, we have showed the two main multipliers, one that was twice the ATR and one that was 1.5 times the ATR. For the take profit, common levels include 1 to 5 times the ATR. Generally, with a low ATR multiplier like 1, we have a conservative approach with a low risk to reward ratio. While with a high multiplier like 5, we have a more aggressive approach with a high risk to reward ratio. So if you wanted to test the ATR to set your take profit level as well, I would recommend an approach in between, so between 2 and 4 times the value of the ATR. In building our first strategy together, I'm going to use a very simple approach. I'm going to calculate the stop loss by using the third method of the ATR, just like we have done for this trade, and then I place the take profit in order to match the amount of pips of the stop loss. So in this case, the stop loss is 14.4 pips. I will set my take profit at 14.4 pips as well. This will give me a risk to reward ratio of 1 to 1, which means that my risk is the same as my potential reward. In simple words, if I'm risking $10 for this trade, for example, my potential reward is also going to be $10. Okay, we now have all the necessary elements to begin building our first strategy together. It's a very exciting moment in which we can put what we have started so far together and make good use of it. So take some rest, make sure you are familiar with the concepts we have seen so far, and in the next lecture, we'll embark on the journey of creating our very first trading strategy.